You're watching Absolute Return, Australia's hedge fund focus. Well, Headland's Global Diversified Fund has exposure to bonds, currencies, agricultural and industrial commodities, with a view to achieving a positive return for investors regardless of equity market performance. Headland Managing Director is Jerry Pressnell, and he's here with Australian Fund Monitor's Chris Gosselin to discuss the global macro strategy and the specific investment models used by the fund. Chris, I just want to quickly ask you, because last week we did talk about global macro as a strategy, but there are obviously differences within the strategy. Can you just give us a bit of an explanation of that and where Headland sort of fits in, I suppose?
Sure. Major differences between discretionary and quantitative. So last week we talked to a discretionary manager who researches markets, looks at markets, and based on that will try to get on a theme or a trade. As opposed to that, there's a quantitative strategy or model which uses computer models, pricing, Jerry will tell us more about them, that is more computer-driven. And that quant basis is quite different. Same markets, so still the same markets, but just a different way of getting buying and selling signals. OK. Well, Jerry, talk us through how you make investment decisions, because it is, you know, quite scientific.
Sure. Well, I think, first of all, when we were looking at developing the product, we realised that investors didn't have enough diversification in their portfolios. So we wanted to develop something that would allow investors to gain diversification. Hence, we concentrated on those three market sectors of currencies, commodities and fixed income. What we found is that there is repetitive price action, repetitive patterns within markets. I'll give you an example. When the Reserve Bank starts to move interest rates, they don't tighten one month, ease the next month, tighten again the following month. You tend to get a fundamental cycle from boom time to a recession, and interest rates will follow a pattern. What our models do is identify those trends in markets, so whether it be the industrialisation of China causing oil prices to go up, or a banking crisis causing interest rates to fall, we're looking to identify those trends and then invest along with those trends, keeping a very diversified portfolio to give us a good risk-adjusted return.
So where does the sort of the computer modelling fit into that? It obviously takes humans to see the trends, and then you...
Well, actually, with signal-to-noise analysis, computers are very good at taking the emotional side out of trading. So, you know, when oil gets to 100 and everyone says, well, it's never been here before and it's not going to go through $100, you know, computer models that are very systematically analysing the data and looking for trends don't get caught up in the emotional side of markets, and therefore can make better investment decisions.
OK. One of the things you do try to do is to strip out as much volatility and risk as you can. Can you talk us through how you do that, and then how you compare, I suppose, your fund? I mean, what do you benchmark it against? Obviously not the ASX 200, because you're not investing in equities. So sure. What are you up against, I suppose?
Well, I think it's been an interesting couple of years for investors with the ASX. When we started the fund over 2.5 years ago, the daily volatility in the All Ordinaries was just under 1%. So every day you'd expect the All Ordinaries to move about 1%. In the final quarter of last year, it was moving about 3% a day on average. So investors who were 100% invested all suddenly had a fund that was 3 times more volatile than it had been a year before. We try and take that volatility into account. So when markets are more volatile, we'll actually trade smaller, have less on the table, as it were, and that reduces the volatility within our fund. So the volatility in our fund today is exactly the same as it was 3 years ago.
OK. And how do you... Talk to me about how you do that by ways of trying to find various assets that aren't correlated, so you're almost using them to hedge against one another, I suppose.
Yeah, that's exactly right. I mean, even if there's only one theme driving financial markets at the moment, you know, the global recession, different markets are reacting to it in different ways. The US dollar is rallying, commodity prices are falling, bond markets are rallying. US bond markets are rallying more than Australian bond markets are rallying. So even though there are a limited number of themes in markets, there's still different participants acting on different markets at different times. So we're trying to look at the relationship between all those markets and find where we can build a portfolio where, as you say, some of those risks are being hedged, and, you know, we're looking to be long some markets, short other markets to get a more diversified portfolio.
I know, say, 5 years ago it was pretty obvious you had equities and property and you could, hedge them off against one another, I suppose. I mean, there were very clear ways of things happening, which seems to have changed quite a lot. In the asset classes that you invest in, have there been big changes as well?
Yeah, certainly. There's been structural changes in volatility.
So in terms of correlation, I mean, specifically, are you seeing some really interesting trends there?
Yes. There are various themes coming through all the time. We look to try and add markets that aren't driven by the same set of fundamentals. So we trade agricultural products. They tend to be driven by other supply and demand fundamentals, the weather, demand for food production as countries become wealthier. So there are markets that are being driven by other fundamentals other than the global recession, and that really helps us find diversification in the portfolio.
And going forward, Jerry, I mean, you get all these models, you get the numbers, they give you signals, they don't make all your decisions for you. But what are you seeing in the market? We're talking about recession. Do you think this is going on for a lot longer? Where do you see interest rates going? Where do you see equity markets going?
Well, our process is driven by investing in long-run trends. So I think it's been very interesting the last 3 weeks that we've seen the stock market rally almost 17%. But in terms of time, that hasn't registered for our models. It could be the start of a new trend, and we hope it is, but it's just too early to say. At the moment, the fund is positioned to be long bonds. We think government interest rates are going to continue to fall. We'll be in a low inflation environment for some time. The commodity prices will continue to fall because there's an oversupply and falling demand. And there's a lot of flows back into the US. So the US dollar is actually appreciating at the moment. The last 5 or 6 years, we saw money coming out of the US, going into growth markets, going into commodity, coming here into Australia. That money's now being taken out at quite a fast rate. So we're seeing the US dollar appreciating at the moment, and we expect that to continue for some time.
What trends are you seeing in agricultural commodities? We sort of touched on it earlier, but obviously there's a lot of issues there as well. What are you seeing?
One of the major ones this year has been falling oil prices. Last year, people were looking at alternative energies. They were looking at sugar. They were looking at corn to produce alternative energies. Now, oil's very cheap. You don't need agricultural commodities. Agricultural prices are falling. That, in turn, has actually made feeder prices for live cattle, pigs fall as well. So you're actually seeing protein markets fall at the same time as carbohydrate markets.
What do you think is going to lead us out of this crisis? Every person I speak to has a different view. Where do you see the initial sort of tipping point, I suppose, in an upward direction?
I think there was too much money washing around and too many assets. Whether it be commercial property or whether it be businesses, that oversupply has got to be taken out of the equation somewhere. So that not until that happens will we get back to a normal growth cycle again.
And would you be prepared to say when you think that'll be? Is that a year, 2 years, 3 years, 5 years? We hear some people talking. So this is a 10-year trend.
I think we'd be exceedingly lucky if we were through this crisis in 5 years.
Wow.
5 years. Okay.
How difficult is it for you to manage through? Obviously, it's a fairly clear question to ask a long-only equity manager, how difficult it is to trade through this. What about for someone in your position who's not, in equities, but obviously all the assets you do invest in are still, everything's tied together. There is still an impact. How difficult has it been for you the last year?
Well, I think we have an advantage over long-only managers. I mean, they can just invest in the benchmark and hope it goes up. Last year they got it wrong. We have a roadmap and a plan of what we will do if volatility increases, stock markets fall. There's a major change in the supply of bonds in the market because we've done that research and that's already programmed into our models. So for us, it's just making sure that we stick to our game plan and do what our models are telling us. And as I say, we have this roadmap to get us through these contingencies.
Taking the emotion out.
Yeah, look, I think what's interesting is you start to get correlation between oil prices and feed prices for cattle. And I think that's something that not many people would register as being linked. So there's some interesting thoughts on that.
Gentlemen, Jerry Pressnell, Chris Gosselin, thank you both very much for coming in.
Thank you. Thanks, Kylie.
That is all we have time for in this edition of Absolute Return. If you've got any questions or comments about the program, or if you have any asset managers you'd like to hear from, you can drop us an email, yourmoney@skynews.com.au. I'm Kylie Merritt. Thanks for your company.